Welcome to Season 4 of the FARcast, bringing you experts and insiders every week to help you navigate the economic and investing landscape. And now, here's your host, Michael Farr.
Welcome to the FARcast. Thank you so much for being with us again this week. I am Michael Farr, and I'm so glad you're back with us. We have a very important FARcast this week. Markets are churning, and it might be the beginning of a correction. Down yesterday, and futures are down about 500 points this morning. The 10-year Treasury yield, as the benchmark interest rate yield, is rallying. The yield is falling, the bond prices are going up, and we're down close to 1.25%. Ladies and gentlemen, it was 1.75% a month and a half ago. Now it was, we talked about it when it got to 1.5%. Now 1.25%. JP Morgan out this morning saying it could go to 1%, and that won't matter. Is the market ready to correct? What happened in just a week? A week ago, everything was fine. We were talking about the expansion and more money coming in from government and high savings rates and $4.6 trillion in money market funds, and there was nowhere to go but up, and now everything's going down. This moody market has me confused, and when I get confused, I go to talk to Jim Lebenthal, Cerity Partners, CNBC contributor, anchor of the halftime report. I mean the anchor in terms of the intellectual anchor, not Scott Wapner. But really, if you need the smart guy, you go to Lebenthal. Hey, Jim, welcome back.
Michael, thank you. Everything you just said is what could be said about you and is said by me.
I thought I was the only one who said that, me and Mom. Jim, this morning, futures are correcting, and all of a sudden, the economic recovery isn't going to be very good. I don't know how we got here. That's what I've been hearing. The economic recovery isn't going to be that good. It's overrated, and the Treasury yield is telling you that the economy is not going to be good. Now, Jim, I got to tell you, we have Dr. Jeffrey Lacker, former president of the Richmond Federal Reserve Bank in Richmond, a distinguished economic professor at VCU, one of the smartest guys we know. He's going to come and talk to us about what's going on, how we should interpret the Fed minutes, whether all of this matters in our third segment. I can't wait to hear from him. But you're probably going to steal all his thunder and explain it to us ahead of time. So.
No, I'm going to probably be set up to be absolutely corrected by Professor Lacker, and the reason I say that is because what are we worried about right now? We're worried about Treasury yields.
Yes.
Who has an awfully big effect on Treasury yields is the Fed. I say that with a chuckle because there's no really way to describe the size of that effect. But let's pause for a second. Really, what the market is worried about is this decline in Treasury yields from 175-ish. Back in March to 125 today. And the stock market seems to be saying, wait a second, this means there's growth is going to slow down. We're not going to get the profits that we expected, and let's all run for the hills. I think that's the wrong way to look at this for many reasons. But let's start with what I observe is that for the last 2 months, Treasury yields have gone down on every piece of economic news. Even, that May CPI number, the first one that kind of freaked people out, albeit
Right.
it was because of baseline effects, Treasury yields went down.
Right.
Then you got a couple of bad jobs reports, Treasury yields went down. Then you got a really hot jobs report, Treasury yields went down. Treasury yields are only going one direction, and they're not linked to what the economic statistics are saying. That tells me to stop right there and say, this is not a Treasury market that is marching to the beat of what the economy is doing. Then let's answer the question of what's the economy doing? And it looks to me like it's doing pretty well. You look at TSA traveler throughput, very, very high. You get these anecdotal notes of people coming out from the pandemic bunkers, kids going back to school, which means people can get back to work. Profits. Now, this is important, Michael, and I know this is where your head is. I know this, right? Second quarter earnings are going to start being reported next week. Let's see how high those profits come in. Expectations are 60% year-over-year growth. I want to give the microphone back to you, but I want to do it with this handoff. That's going to be 60% year-over-year growth. There's only one direction that the growth rate can go from there. Of course, we're going to hit peak growth, whether it's profit growth, as I just said, or economic growth. I think the Atlanta Fed's around 10% real GDP. If it's not that, it's close.
I
But
wonder if Lacker, I'm sorry to interrupt, but I wonder if Lacker, when he gets on here, can tell us what data the Atlanta Fed uses that nobody else uses. Have you ever seen the Atlanta Fed within 100 basis point handle of any other consensus number? I mean, I don't know what's going on with, I'm sorry,
Michael,
the Atlanta Fed numbers are always off the scale. They're just nuts. Go ahead.
then make it 8% real GDP. That's the
right.
number. Of course, we're going to slow down from there. But the rate at which we are going to slow down, the second derivative, is not something that I'm looking at right now and feeling scared at all. What I see is we're in an early economic expansion in which there is still stimulus in the system. There's still an accommodative Fed. There are profits that are going to be recycled by companies into building new plants, buying new technology, hiring new workers. We're a long way from an overheated economy that the Fed's going to come in and slam the brakes on. All right, I just hit about a half dozen big topics. I'm going to throw the mic back to you. I don't know where you want to go. You got to pick one.
I think, well, first of all, I think you did a beautiful job. I really do. And I think it sums it up. I want to come back to this change in sentiment in just a second, but I want to also share that the Federal Reserve right now, I cannot wait till we talk to Jeff Lacker. The Federal Reserve right now is buying 100% of net new Treasury issuance. Of net new Treasury issuance by the federal government from the Treasury Department, the Federal Reserve is now buying 100%. So here we are, ladies and gentlemen, in this world. I mean, you thought Alice in Wonderland, you thought Lewis Carroll had an imagination, right? I'm telling you, we got one branch of government that's issuing all sorts of debt to pay for whatever the hell we want to pay for, good or bad. Let's not argue about what we can't afford it. So we're paying for it with a ton of debt. But wait a minute, how do we afford the debt? Well, the debt doesn't cost too much because the interest rates stay low. How do you keep that going on? You make sure that somebody buys it and create demand to keep those interest rates low. Well, we don't really have enough people to buy that debt to keep those interest rates that low. Oh, don't worry about that. We'll have another branch of government buy all of that debt, keep those interest rates low. How much of it do they have to buy? Well, most of it. Really, most of it? No, not just most of it, all of it. All of it? Really? And that'll keep the interest rates low, and then you can keep borrowing money at those low interest. And this sounds like a plan to you. You know, Jim, when I was 17 years old and would ever occasionally get caught doing something I wasn't supposed to be doing, I would have to say, some parent, often my mother was much tougher than my father, by the way, would, look at me and one of my errant friends and say, "What were you thinking? What in the world were you possibly thinking, young man?" And I just can see our children and our grandchildren looking back at us and looking right at Dr. Jeffrey Lacker in particular. Actually, he was always a hawk. If they'd listened to him more, I think we'd be in much better shape. But what were you people thinking to do this to our economy? So I'm sorry, Jim, for my rant, but when you get into that new Treasury issuance and you see these starts of falling in yields and rising in prices, you also get into a short squeeze situation that exacerbates, right? It exacerbates a move in any direction. So people are short, the yields go down. When you're short, you've sold something hoping that it falls. What happens? Prices start going up and up and up, and you probably borrowed money to do it, and now you're in trouble, and you have to buy that security back in. What happens when you go in to buy it back in? It drives those prices even higher, particularly if a lot of people try to do it at the same time. All right, Jim, you went on your rant. I went on my rant. Out of the 16 things I just said, what do you want to address?
First, I want to address the impressiveness of that rant. It is, after all, your show. I think Rick Santelli is getting a little nervous. Hearing that rant, he may be thinking he's got a competitor. No, in all seriousness, that was excellent. And as we both do, you give directions, plural, that any one of us can go on. I'm going to tell you where I'm going with this. It's July 8th, okay? It's less than 2 months from the federal tax filing deadline, okay? So you were talking about all of the treasuries getting sopped up by the Fed. I'm going to put out there that there's another technical aspect of what's going on in the treasury market, which is that we're seasonally at a point where treasury issuance is low. So you've got a seasonal supply constraint in treasuries that I think is also exacerbating the situation in the treasury markets. You brought out the shorts, and then they pile on, and then there's lower interest rates, still negative, German 10 years, Japanese bonds. All of these factors are combining to bring the treasury yield down. But I will tell you that what I'm going to repeat the point from earlier. What I don't see here is a true growth slowdown. Now, I'm going to use that terrible phrase that even I hate to say. The market is due for a correction. The stock market is due for a correction. And if we get one, what we have to remember, and this is to all of our listeners out there, when you're in the middle of a correction, it always feels like something worse. And there will always be plenty of pundits who will tell you, this is it, head for the hills, growth is going, the sugar high is off, the Fed can't do it, the end of fiscal stimulus, you're not going to get infrastructure, there's no virtuous cycle in which profits are going to get recycled into the economy. I've just seen this movie so many times that I know the advice to give, and so do you, Michael, is to just buckle your seatbelts and get through it. Don't try to time a market correction. Just calm down, relax. Maybe it lasts 2 weeks, maybe it lasts 2 months, but just get through it.
And you just get through it. But Jim, so let's go here. This is the final thing I really want to get. What do you do when you see this? Look how quickly this emotional shift has happened. I mean, when you look at stock prices, earnings are up 20% right now, year over year, and stock prices are up 15%, which means we've had a multiple contraction. We've had a contraction in price to earning multiples. The market now actually represents a better valuation than it did. As you say, we're going to have 60% year over year growth. The growth might not be as magnificent, but we're still going to have growth on top of growth. That's compounded growth, folks. Growth on top of growth, by definition, is compounded growth. So earnings that have gone up are going to go up even more. I don't care what those percentage numbers exactly work out to be, it's more. So how have we, in a week's time, gotten so doom and gloom, and how do markets shift that quickly? And this is the kind of thing that upsets Fred and Ethel.
Well, first off, there is caprice in the market, and Fred and Ethel and you and I know that. And this is the wisdom of having some gray hair to say, this is just the randomness of the walk down Wall Street. Don't try to follow the intricate moves of the market, just follow its overall direction. Now, I do want to say one thing about this intricacy of the moves of the markets. There are wide swaths of this market that have already corrected. And I think what's bothering many of us is that the reflation trade, the reopening trade, has already corrected. I mean, you look at airlines, you look at financials, you look at industrials. I mean, I'll take a look at JP Morgan, take a look at Caterpillar, take a look at our beloved CVS, a healthcare stock. All of these stocks are off more than 10% from their recent highs. And I think that may be what is worrying people, is that underneath the market itself, as measured, say, by the S&P 500, a lot of stocks have already corrected. I say to you, Michael, and to our listeners, that's good. That's good. We're already set for the next leg higher. It's interesting, though, that the market the past few weeks has been propped up by last year's technology trade. You see Amazon setting a new high. You see Apple threatening to set a new high. I think that that's okay, but I'd really like to see, and I do expect to see, the broadening of the rally occur once again. That was what was so beautiful from September to about April, May of this year. Since then, we've had this narrowing of the market leadership. I think we're going to see that broadening rehappen because so much of the reflation trades, so much of the cyclicals have already corrected, leading them to the next leg higher. And that's my thesis. But that doesn't mean it's tomorrow, Friday, July 9th. It might be August. It might be September. Please, my last word to all of us is just be patient, just relax. We've been here before. This is not new news. Just buckle your seatbelt, calm down. We're going to be fine.
To quote our president, Joe Biden, here's the deal. Here's the deal. There's $4.6 trillion sitting in money market funds. 3 weeks ago, banks in this country returned $500 billion to the Federal Reserve because they didn't want it on their balance sheets to impair capital ratios because they didn't have anything to do with it. There is no velocity of money out there, and there is a ton of money. There is a ton of liquidity right now in this economy. So if you've seen these pullbacks over the past few years not last very long, listen to Lebenthal, but pay close attention. And also listen to our friend Art Cashin, who suggests that you should be very nimble right now. If you've got cash on the sidelines, you're waiting for a pullback. It hasn't made a lot of sense to wait too long. I don't know how to market time. I've never been able to do it. 30 some odd years, I've never been able to do it. And I've never seen anybody do it successfully over time. So there's a lot of cash, folks. And the story, as Jim Lebenthal has just told you, is basically still intact. The economy is still expanding. There's plenty of cash. The consumer has cash. We're still reopening. How does this really go sideways? It's a struggle to understand. Jim, any other final words other than you sound like really British royalty? You know, stay calm and carry on. And perhaps, you know, Jim, we ought to talk about your heritage a bit. I suspect there could be some British royalty there somewhere.
There's German austerity in there, Michael. That's what you see. Lebenthal. I think common sense, Occam's razor, applies here. Just look at what's going on in the economy. Let's not worry about treasury yields. And boy, you brought up the reverse repo market. I've been reading that for the last 3 weeks, trying to understand how that's affecting the market. I haven't quite figured it out, but I got to tell you something. There's a strong scent that has a big effect on what's going on here. And you want to talk about a transient, temporary effect. Don't worry about these things, folks. Just look at what the economy's doing. Just get out there yourself. See people getting back to work, kids getting back to school, people flying again. This is an early economic expansion. Enjoy it. Don't worry so much.
Listen to Lebenthal, folks, and one thing you're not hearing is you're not hearing Lebenthal and Farr talking about what we're going to go out and sell. I don't have anything I want to sell. So pay attention. We stick with our long-term discipline. Jim Lebenthal is a partner at Cerity Partners, a contributor on CNBC. Listen to Lebenthal, also one of the nicest guys you're ever going to meet on Wall Street. When we come back, Dan Mahaffey from the Center for the Study of the Presidency and Congress to explain what's going on in Washington and around the world. Why is China deciding that they don't want to list their companies anymore? I thought they liked other people's money. We'll be right back. Please stay with us.
Michael Farr and the Farrcast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the Farrcast and your host, Michael Farr. Welcome back to the Farrcast, and now here's your host, Michael Farr.
Welcome back. Joining me now, Dan Mahaffey from the Center for the Study of the Presidency and Congress, the senior political analyst on the Farrcast. Coming here to the end of season 4. We're going to start season 5 here. Dan, are you ready for season 5, do you think, of the Farrcast? God, it's exciting, isn't it?
It is. Born ready. Let's go.
Born ready. All right, Dan. I got China that doesn't want its companies listing in public markets. I've got more Russian hacks. I've got U.S. leaving Afghanistan. And I've got Mitch McConnell who says, no, we're not going to do anything with anybody. Okay, where do you want to start?
Well, why don't we start quickly with Washington? Let's get that out of the way. I think.
Oh, yeah, good luck with that.
At least for this segment here. But
okay.
We haven't seen too much change on many of these timelines. We've had the 4th of July Independence Day recess. A lot of this has been politicians selling this on the road. We just saw Biden in Chicago doing that. Other politicians lining up for or against this. And look, the bipartisan plan is still there. I think that's on track. Democrats will still move with their own reconciliation plan. The only thing that really raises a question about that timeline is, when does the debt ceiling get hit? Do they have to go back to the previous resolution to open that to address the debt ceiling, or do they have to move up their plan on the second reconciliation to address that? That was a concern. The noise now is that some of the extraordinary measures, the receipts that are coming in, has pushed that past the recess. It's not going to be a concern until September.
I'm kind of waiting to see if Janet Yellen, how she's going to do actually as Treasury Secretary. My impression of her, as I've always admired her greatly and had great respect for her, but she strikes me as a Fed chairman who's playing Treasury Secretary. As she comes up to a debt limit now, we're going to find out if she can actually be Treasury Secretary, because this one is actually only and solely right in her damn lap. So good luck, Secretary Yellen, but we hope you get this one right. Dan, it does look like Washington is hitting this typical delays. It doesn't look like we're going to see this infrastructure bill much over this summer. Does it? Do you think we're going to get it before they go to recess?
I think you're going to get at least what the plan looks like before recess. They've got to get something on that to stay on track. Beyond that, though, look, you're not going to get it put into place before the recess, though. It's Washington in the summer. It's moving on that famous Washington gear. You know, Kennedy said, a city of northern charm and southern efficiency.
Yeah, well, and the politicians who really can't seem to get much more done other than focus on their reelection. How many hours a day? I love this stat. How many hours a day does a congressman spend, Dan, you told me this, spend raising money on the phone?
About 6 to 8 hours on the phone raising money.
6 to 8 hours a congressman is on the phone every day?
Yes.
Every day raising money, 6 to 8 hours. That's what your elected representatives are doing, ladies and gentlemen. And what does it cost on average to win a congressional seat in this country?
Last time I ran it, about $2 million for a House seat and about $10 million for a Senate seat.
There you go, folks. You want to be a member?
And obviously, as a Senate seat in Illinois, Florida, New York, way beyond that. So
probably you want to be a senator from like South Dakota or something where the population's maybe 1 million. What do you think?
Wyoming is probably
Could you do Wyoming for maybe 4 million, Senator? What do you think?
Wyoming, you just need one oil company in your senator.
Okay. Perfect. All right, Dan. Let's go.
Pre and post Didi, I think, is how we need to look at China listings.
What's Didi, Dan? Tell us.
Didi is China's Uber, and that was did their big IPO. And here's the crux of this. We're going to talk about the IPO side of this, and I think it's going to definitely cast a pall over future IPOs by these Chinese tech companies. But this is not a capital question out of Beijing. This is a data question. And that's what it fundamentally comes to. And I think as we see Xi Jinping putting his imprint on the Chinese economy, Xi Jinping thought is moving past capital. It's moving past the Deng Xiaoping era of opening the Chinese economy to where it's much more about managing China. The way you kind of see their writings, it's almost like Sim City on steroids, where you have government digital currencies coming and going as they need, systems constantly gathering data on citizens, what they're doing. And what the Chinese realize is that the Didis with everyone's driving and their orders and their Ubers, Alibaba with their payments, AntPay with their lending and money, all of these companies have giant data dashboards on the Chinese citizenry. what they do, what their preferences are, what they're eating. All of this they see as a major national security, state control matter. And when you have your capital going overseas to these other listings where you have Western auditors, Western accounting standards, they begin to ask, well, what are the Americans, what are the others learning about our data? We missed it in many of our headlines here. Americans, we're kind of concerned about our Teslas catching fire and us being trapped inside. The biggest scandal in China was actually what data was being gathered. And then what the Chinese government can do is they take a firm, they can control the social media, whip up a public frenzy saying, right, this company's giving the foreigners our data. Look at, Elon Musk is doing this. The Western company comes back, hat in hand, sorry, agrees to another round of data restrictions. And what you see is, there's plenty of us in the West talking about capital, and those of us with capital might as well be thinking about this like the Lancers in the Polish army charging the German data tanks in a way, because that's what they're seeing as the future.
By the way, ladies and gentlemen, if you have never seen that film footage, the Poles on horseback with lances charge the tanks, it's remarkable footage. It actually happened. Talk about a mismatch. Anyway, same sort of mismatch here, Dan, perhaps. Are the Chinese correct in being that concerned about data from their rideshare service getting out? Is that a real vulnerability as you understand cybersecurity?
Look, it's not so much a vulnerability as it's just a matter of, again, societal control, management, and data about the society. They see that, data is going to be the fundamental underpinning of economic decision-making, of how companies and societies are managed. So they want that. It's simply control is what it comes down to. And the vulnerability is, what they do is they turn it against us, where it's the idea of, how do you look at Americans' travel patterns, preferences, et cetera, to either better market them or to figure out whether they're a CIA spy.
Got it. And I got to keep moving on here, but China just had their big celebration of communism. Woo-hoo. Hope you all enjoyed that. And we heard a lot of sort of angry, more aggressive rhetoric against the US and the rest of the world of, you all are judging us, you're moralizing, you're preaching to us, we don't need to hear you. This was a different tone. We've heard it underlying in China communications for a while, but boy, this got loud pretty quickly. What does that mean?
This is the fundamental basis of Xi Jinping thought foreign policy, is that China has now developed to the point that it can show its strengths. It no longer has to bide its time, as Deng Xiaoping once advised. And now it's time for China to remake the system into its own interests at a time when Western democracies have become weak and divided.
Is Xi Jinping China's version of Donald Trump? In some way, is he more of that personality? Is he a little more like Vladimir Putin?
No, I think within their context is that he is really putting himself as the next Mao at that level. That he's no longer built by the consensus. It's hard to compare him to an outside model. You have to think within their system, and Mao is the best one to think of.
Mao. Okay. He certainly has his term limits in line to be the next Mao. We'll see how that works. Okay.
From great helmsman to great manager.
Well, it's going to be more permanent than anything else. As long as you don't get thrown out, you get to do whatever you want, I guess. Russia's going to continue to hack. Apparently, after we had Biden go over there, Biden had these great, very tough conversations with Putin, and the hacks just continue. Nobody cares.
Well, no, this is where I think there's going to be some measures. We're going to have to enforce this new red line. Is it harder sanctions where we start to actually hit Russian sovereign debt dealings? Further sanctions? I don't think you can further target anyone in Putin's inner circle, but you got to turn some more screws on the Russian economy. That's going to be hard to find more pain points. And I think we're going to have to start hacking back. The question I throw out there is, I think every U.S. company, U.S. investor needs to be thinking about what a tit for tat cyber war is going to start to look like over the next few months, because that's a very good possibility. So
I have
look
this
for
sense that China is sitting back and watching gleefully this cyber war with Russia, saying, "Just wait until we
Well, I
get
think
involved."
all of these bad actors like it, because no matter this kind of a broad ransomware attack, it's the equivalent of tying down resources. So remember when the in Die Hard 3, when they bring all the police and they scatter them around to find the bomb in the school. That allows you to then hack the RNC better. It allows you to hack the crown jewels better. It scatters the way that the resources so that you can find other ways in.
I have this impression of just saying, "God help you if you were to hack and find out what was going on inside the RNC." I mean, God help you if you had to see what was going on inside the RNC or the DNC, either one of them. I can't imagine that's very pretty. Finally, Dan, because I'm out of time, give me, so we're out of Afghanistan abruptly. I saw it on the nightly news last night. It sounded very bad. Is this something, what does it mean, do you think, for the region quickly? And then, to my mind, more important, what does it mean to President Biden, his credibility, his popularity ratings, and his ability to get things done? Is he going to take a hit over getting out of Afghanistan?
Look, I'll answer those in reverse order. I don't think he takes that much of a hit, because I think Americans are ready to be done with this war. However, if there is another, God forbid, Al Qaeda attack on the homeland, that does raise that. But that's a whole previous threat environment in many ways. I don't want to be dismissive of it, but it's a playbook we have and can address. On the other hand, I think their strategy, though, is completely out of line with reality and how quickly the Afghan forces are falling, the inability of the Afghan government. We tried to build a government and military in our image in a country that could never support it. It's collapsing. And I also think any plan to do this from afar, from the Persian Gulf or the Indian Ocean, just beggars military comprehension, because you're just so far from a landlocked country.
And Dan has quite an expertise and education in security studies as well, and of course studied and lived in China, speaks Mandarin. So we listen to Dan rather closely on these things. All right, Dan, anything keeping you awake right now at night? We got to go. I got to get to Jeff Lacker. I can't wait. And this has been fabulous. I've learned a lot. So please, what's keeping you awake right now? Anything?
What's keeping me awake right now is I think we need to keep getting this country vaccinated. I'm really worried about these pockets of this country where this is going to pop up and new variants will emerge.
Markets have been following, remember, ladies and gentlemen, the whole process and progress of this disease for well over a year. You've listened to Jim Lebenthal and me and others when we're on CNBC and talking about the economy, the reopening, the everything else. Watch what happens to the virus. And throughout the fall and early winter, markets followed the virus. If the virus comes back, pay attention, because that's going to start dictating the tune. You're not going to need to listen to the Fed. You're going to need to pay attention to that virus. All right. Again, longer-term economy continues to expand. Dan Mahaffey from the Center for the Study of the Presidency and Congress, senior political analyst on the FARcast. When we come back, Dr. Jeffrey Lacker, he's a distinguished professor at Virginia Commonwealth University of Economics, and former president of the Richmond Federal Reserve Bank and one of my great longtime friends. We'll be right back. Please stay with us.
Thank you for joining us on the FARcast. And now, back to your host, Michael Farr.
Welcome back. Joining me now is Dr. Jeffrey Lacker, distinguished professor of economics at Virginia Commonwealth University, former president of the Federal Reserve Bank of Richmond, one of the smartest economists you're ever going to talk to, and one of the nicest guys. And you know something else, folks? Most economists are just dry as dirt, and Lacker really isn't. He's kind of fun. He's a race car driver, he and I have marinated several ice cubes in bourbon over the years and solved lots of the world's problems. We hope maybe we can solve a few for you today. Hey, welcome back to the FARcast, Jeff.
Thanks. Great to be with you, Michael. Looking forward to marinating some more ice cubes with you real soon.
That's Art Cashin's term. He says, I'm going to go marinate some ice cubes here. I like that. So we need to do that again soon. All right, Jeff, the Fed's buying 100% of Treasury issuance. Interest rates are dropping like a rock. People are all worried. And the Fed minutes sort of say they are maybe getting a little concerned, or they're going to talk about getting concerned. What do you make of where the economy is first, and then what's the Fed going to do about it second, please?
I think the inflation surge is definitely the number one story still on the macroeconomic front. There was a huge amount of fiscal stimulus dumped into the pipeline over the last 15 months. It's piling up in household checking accounts, and while people were locked down, while people were not comfortable going out to restaurants and shopping centers and movies theaters, they weren't spending it, and now they are. On top of that, what we've seen is a huge, widespread set of bottlenecks and labor shortages that's impeding the economy's ability to supply what people want. It's a classic demand-driven inflation surge. I think it took the Fed by surprise. I don't think they were thinking it would be so strong. They were forecasting a pickup in inflation, but nothing like what we've seen over the last few months. The labor shortages are serious. A lot of people left jobs last year, were laid off. A lot of them don't want to go back to working in a restaurant or somewhere else like that. So there's industries that are scrambling to try and find people that want to work there. In addition, you've had a lot of retirements accelerated. It's not clear that that's a two-way street.
Right.
It seems plausible. A lot of people are just going to stay retired. So it's not obvious what we're going to get back to, that we're going to get back to January 2020 in terms of the level of employment and economic activity. It could well be something below that and take some time to find that new equilibrium. And then on, the supply chain stories have been well told, from semiconductor chips in the auto industry to transportation problems and the like. The big question is whether this is transitory or persistent. So if it's transitory, it's just a temporary adjustment problem. And as labor shortages get sorted out and these bottlenecks in the supply chain get sorted out, you'll see inflation subside maybe at the end of the year, plus or minus like fourth quarter or first quarter. And things proceed apace. The recovery continues. Unemployment declines, people come back out of the labor force, and we get back to where we're going. That's the scenario that the Fed likes, that the Fed leadership is putting its money on in some sense. The other scenario is not so good. It's one in which inflation persists at a kind of high level, 6 to 8% at an annual rate over the next several quarters. And people start thinking that's going to keep going. And people start acting that way, and people start expecting higher inflation, and that actually builds in some momentum to the inflation process. That's kind of the nightmare scenario for the Fed. The Fed the Fed's communications, though, are going to remain sanguine. They claim they've got the tools to do that. They say we've got the playbook. That happened in the 60s. It took till 1980s for them to actually figure out how the playbook worked, and that they have to raise rates and cause a recession to get the inflation rate down. But they're convinced, yeah, we know how to do that. We'll just hammer the economy, have a recession, get inflation down, and restore order. On the sanguine side, that's where the majority, I think, of the committee is. But they had to acknowledge in the minutes yesterday that the risks of a less sanguine scenario have distinctly risen, and it's something they're paying attention to. So for some participants, it causes them to sort of move up when they think they're going to raise rates. So now the median is a couple of interest rate increases, policy rate increases in 2023, the year after next. But the policy move that's immediately on the horizon is tapering asset purchases. That's the thing. They'd have to do that first before they raise rates. because their playbook says that's what order you do them in.
Okay,
and so that's the big question.
To quote my friend Jim Lebenthal, you've just covered at least 6 or 8 things that I've got to figure out how in God's name I'm going to unwrap. And I'm not sure how I'm going to do all of that because it was so much detail and very helpful and brilliant. Let me get very basic for a second. Fred and Ethel are listening and they know I've got a very smart, Federal Reserve president on here. The economy good or bad right now, Jeff?
I think on the whole, it's good. I mean, you got to handicap it by what they've had to cope with. A virus that sent everyone home, made everyone afraid to go out, and
but good. The economy's good. The economy's growing right now.
Yeah, it is.
Is it
I mean, you were making fun of Atlanta and their growth forecast for the second quarter. It seems plausible to me that we get well above 5% GDP growth for the second quarter. This is quarter 2 over quarter 1. That's plausible at an annual rate. Going forward, I think there's a lot of uncertainty about how rapidly we're going to grow, but still we're seeing, what in normal times would be gigantic employment gains and gigantic GDP gains.
So the economy's growing. And granted, we're growing from this huge shutdown, but we're in an expansion mode of the economy. So what can derail this expansion mode? What gets us off of an expansion mode and really screws us up? Why can't we just watch this plane take off very slowly and gradually along the runway and gain elevation?
Yeah, two things. Two possible scenarios. One is the second scenario I talked about, in which inflation persists beyond next year and the Fed feels compelled to raise rates kind of aggressively in 2022. The other thing that could derail it is a new surge of COVID. Maybe the new Delta variant sweeps through pockets of the country that where vaccination rates are low. That forces them to go into kind of shutdown mode, and that disrupts supply chains. Creates more bottlenecks and reduces spending and has a dampening effect on the economy.
And Dan Mahaffey mentioned that, and I think it's very important. Let's go back to that persistent versus transitory risk there. As I understand it, in my very simple understanding of economics, if I look to sort of come up with GDP growth, I look at that growth in the number of workers plus productivity. And I get beyond this current surge and I see, wait a minute, I don't have really many new workers at all. And I can take productivity up by 50%. And I still don't have 2% GDP growth once I get out a couple of years past these numbers. And so that to me has been what's underlying this transitory nature. Maybe the surge is transitory and it levels off and whatever we pick up becomes persistent, but the rate of growth basically levels out and we get back into that 1.75% world pretty quickly. How do you get, so what I don't understand is if I have that to look forward to, if I have that ultimate GDP growth at a 2% or sub 2% number structurally based on population growth, the US now population isn't growing. We're really dependent on immigration. Productivity numbers aren't increasing and haven't for years, and technology in many ways is helping and hurting. So can you get that sort of sustained problematic inflation longer term if I can't get GDP growth longer term?
It's a good question. I think we can. I mean, you have to separate two things. You're definitely right that the last decade or two of productivity growth has been, let's say, soggy, just not terribly inspiring. Having said that, the big thing now is the gap between what we're capable of producing, if we get these bottlenecks cleared out, and the labor market sorts itself out so that people are matched up with jobs and the retirees are in place, people who aren't retired. If the labor market gets itself sorted out so that workers are sort of allocated to what jobs are available, that gap is fairly large, like 5 or 6%. If you chart this employment in this recession versus other recessions, right now, we're crossing the line traced out from the last business cycle peak in 2008 and 9, and it's before the peak. It's like right at the trough of the last recession. So we've caught up to the trough of the last recession, which is still the biggest. That was the biggest recession since the Great Depression. So we've got 5 to 8% of GDP that we could, we can, if we get back to normal labor force allocation and clear up these bottlenecks. So
are you saying that there's a lot more potential growth before it becomes inflationary?
Well, so this is the thing. I mean, we can go through this scenario of eliminating that gap and then transitioning to your sub 2% GDP growth. We could go through that a couple of different ways. One way is that there's this temporary inflation now,
right? Okay,
is what discourages people from buying now and gets them to postpone things that they can postpone. Like if you want a contractor to work on your house, now's not a great time to try and call a contractor and get them to do something before Labor Day. So a lot of people are just sort of, well, I'll wait with that until next year, which is what price increases do to you if they're transitory. Now, if they're more persistent, if people start to bake in, oh, well, the Fed's going to let inflation run, then in that case, inflation could persist, but you could still be tracing out the same curve because supply right now is about what it is, right? I mean, GDP now is about what the economy is capable of supplying. It's not capable of supplying anymore, even though years from now, we could get back up to that 2% growth scenario you talk about. See what I'm saying?
Yeah, I kind of do. I'm trying to put it in the Fred and Ethel sort of a context of that expansion that's going on and what it's going to mean for them. And certainly we've talked to Rob Whitford, who at Precision Marine down in Delaware, who tells me that he's booking work 30 months out right now in construction, 30 months out, and he cannot offer an estimate because supplies keep getting inflated. And he said, I don't know what it's going to cost. So you book me now, and that's it. So, there's the inflation cycle when you expect prices to go higher and you still book it today because you're worried it's going to be more expensive tomorrow. It's those inflation expectations that can sort of seep in, I guess, to your point. Jim Lebenthal, is this making sense to you? And what do you think Fred and Ethel are going to be concerned about as they listen to Dr. Lacker?
Well, as I'm listening to Dr. Lacker, what I'm thinking about is how are we going to look back on this summer from the vantage point of, say, 6 months from now, 9 months from now, 12 months from now? And what I think is that all of the things that we're talking about, I'm not going to quite call them fine tuning, but I'm going to call them things that when we look back are not necessarily going to be that salient. We're still going to see a growing economy. We're going to see these worries about inflation. I'm all right. I'm going to throw caution to the wind and say I think inflation is transient here. I think there's a number of factors here that seem to be passing. We've seen lumber come down. We've seen other commodity prices come down as high prices cure high prices. It's the real wage thing that's what I think people like me are worried about. But if we don't get this Delta variant, burning through like wildfire, then I think the labor force comes back into, increases and we solve that. So I'm listening to it, Professor Lacker, and I'm taking great comfort from the words and the tone that you're talking about, because this is all, and I use that word fine tuning, but that's the wrong word. It's all within the normal operating band of a growing economy.
You agree with that, Jeff?
Yes and no. So, the economy's supply constrained for sure. I think the sanguine inflation scenario that it's transitory is very plausible. I think the other scenario is plausible as well. I think what you're hearing out of the Fed is comforting words. I think that they have every incentive to downplay the plausibility of the persistent scenario. And so, you got to kind of take things like the minutes and the statement with a grain of salt, speeches and everything with a grain of salt from them on that. But yeah, I think it's perfectly plausible that we get through this. What I think is true, though, is that we really don't know because, we've got 20 years, 25 years of stable inflation and stable expectations. We just don't have a good handle on what could mess with that the way that it got messed with in the late 60s, where we went from very low and stable inflation environment in 65 to, 3 or 4 years later, 5% inflation and out of control. And nobody was doing anything about it. And no one thought anyone was going to do anything about it.
Right.
Sorry to interrupt. I know we're going long. One other question here for Dr. Lacker. Does a politically independent Fed survive a inflation spike and then having to come back with a Volcker medicine?
I'm not sure the Fed's as politically independent as it was 20 years ago. I think they volunteer after 2008. I think in a series of steps, they've sort of voluntarily surrendered a little bit of independence. I think they've steered the ship towards political following political winds in the last decade. I think this new framework with inclusive maximum and broad-based and inclusive maximum employment is part of that. I think the climate change initiative is part of that. I think the looking at central, at a digital currency provided by the Fed is part of that. So, and I would suspect that movement would continue, gradual chipping away at their independence.
Okay, I can't believe it. We're over time, but I have two more questions for you. I'm going to spoil them. I'm not even going to tease you. First is, what does it mean to you that the 10-year Treasury yield is back at 1.25%? That we've seen this huge rally in bond prices. What does that mean to you? We heard JP Morgan say today that that's not significant, that you don't need to pay attention to it, number one. Number two, and this is always my favorite question to ask you, mostly because it makes you so uncomfortable every time I ask it. What is the Fed doing wrong right now? What are they getting wrong? What are they missing? And what would you be doing differently if you were back on that open market committee?
Good question. So I would disabuse people of the notion that you should ever ignore the 10-year bond yield.
Yes,
it's one of the most important, kind of financial market prices in the world. And my sense of why they're falling is this COVID risk.
Okay.
That leads them to think, all right, if we get another surge, tightening is going to be put off another year or two. Tapering is going to be put off another year or two. The other question of what the Fed's doing, I think that their new framework that they adopted last year and the language they put in the statement in September sets up a conditionality for keeping rates at zero that has a significant likelihood of boxing them in late next year, early next year.
How so?
Well, they've said they're just not going to raise rates unless they see maximum employment, unless they see it in the data, like it actually happens. Not that they're on track to get there, but that they actually see that. And their one out is like, well, inflation has to be, well contained. So, leading up to if inflation turned out to be persistent, they'd be hard pressed. It would be a huge debate. I mean, there'd be a sort of a firestorm around them about whether inflation was persistent enough to act on, or whether we could tolerate more inflation, as some economists have advocated, and march our way towards maximum employment, because there's no way their indicators are going to say maximum employment's been reached by the
So are you suggesting that could get them into the sort of bind that's going to require a Volcker response that's just going to have to jack rates and really shock us?
Well, the problem is it's the bind that Arthur Burns was in 1971, and he threw his cards in with Nixon and said, all right, we're going to forget about inflation, even though it's 4 or 5%, and we're going to fight employment. And so for the Fed to do that, that would replicate a very bad scenario.
That would replicate a bad scenario. Okay, I'm sorry, I lied earlier. I still have one more question. If this, the solution now to every problem, Jeff, seems to be more stimulus. That's going to solve everything. And you look at the money supply and you look at the velocity of money, which is just in the tank. We've got a ton of liquidity. It's not moving. Why is stimulus still the answer? And what does it take to recover some velocity of money?
Yeah. So I don't think more stimulus is the answer. And I think that Larry Summers has been persuasive that what we've got in the pipeline is scaled too large. I think that the surge in inflation is evidence, in fact, that velocity has increased. That, a lot of that money was just sitting in checking accounts at the end of last year, and more came in January. And I think people started spending it. I think that's what the inflation surge is all about.
And so what is if we get another surge in the variant, right, and we see interest rates low, will the Fed or the Treasury Department, will the fiscal or monetary side of the house feel compelled to do anything about it? Number one, if they feel compelled, and then if they feel compelled to do something about it, what the hell can they actually do that's going to make a difference to move the needle?
I'm not a public health expert, but it just seems like more resources for testing, more education about vaccination, more efforts to get that, to make progress on that front would be more helpful than more money in people's checking accounts.
Ladies and gentlemen, Dr. Jeffrey Lacker is a distinguished economist, professor at Virginia Commonwealth University, former president of the Richmond Federal Reserve Bank, and a great longtime friend of mine. That's it for another Farcast for this week. We ran a little long, but boy, I think it was worth it. I hope you do too. It is July the 8th. We are at the beginning of the third quarter, if you can believe it, for 2021. We will be back again next week with another Farcast. Please share us on your social media. In Washington, D.C., for the Farcast, from Harry Jennings and all of us, thanks so much for being with us. Talk to you next week. Bye.
Thank you for joining us on this week's edition of the Farcast, and thanks to Michael's guests, Jim Lebenthal, Dan Mahaffey, and special guest, Dr. Jeffrey Lacker. We love hearing from you every week, and we try to respond to all of your notes and suggestions. You can reach us at hjennings@farmiller.com. Let us know any questions you have and topics you'd like to hear us cover. The Farcast comes to you weekly and is produced by Michael Farr and Harry Jennings, and is available for free on Apple Podcasts, Spotify, Stitcher, and all major podcast platforms. We would like to remind you that the Farcast podcast is for informational purposes only and should not be considered legal or financial advice. The information, statements, comments, views, and opinions expressed and provided in this podcast, including by speakers who are not officers, employees, or agents of Farm, Miller & Washington, are not necessarily those of Farm, Miller & Washington or any firm any of our guests may represent. Any mention of a specific security should not be construed as a recommendation to buy or sell, and please be aware that past performance is not a guide to the future performance of any security, index, fund, manager, or strategy. We strongly recommend you review with a financial professional before you make any investment decision. And if we can be of assistance at Farm, Miller & Washington, please reach out to me at hjennings@farmmiller.com. We are here to help. I'll be happy to put any of our listeners in touch with one of our investment professionals for a complimentary review of your portfolio and your investment goals. Take care, stay safe, and stay healthy. Please share the Farcast as we finish out Season 4 here in coming weeks. And join us next week as we welcome special guest, former Deputy White House Press Secretary, Tony Fratto. Go beyond the headlines each week with the Farcast. Wall Street, Washington, and the world.